bubbles are getting bigger and bigger. The amount of debt outstanding is growing exponentially. We now have 50% corporate debt to GDP, lowest and tightest spreads to treasuries ever, lowest interest rates ever. Triple C debt rated triple C, which is the junkiest of junk, was below, over 100 basis points below the normal rate for treasuries. Okay? This is what's happening in this country.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us kaiser@milesfranklin.com. Welcome back to Liberty and Finance. We have a returning guest who's always popular with our viewers. This is Michael Pento, the founder of Pento Portfolio Strategies, and he's joining us this Tuesday, May 11th, 2021. Michael, thanks for coming back on Liberty and Finance.
Is it Tuesday already?
Is it even Tuesday? What's the difference? Yeah, we wanted to get back with you because you've been one of those people watching from the crow's nest to see which direction trends are going and which way capital is flowing and which way interest rates and the equity markets and bonds and the bubble of everything. And people are concerned. You know, our whole channel got started because of awareness and preparedness, so people could be prepared for what's coming. And it seems to me of all of the potential threats and risks that people are exposed to, one of the ones that keeps pressing to the front of people's minds is financial risk. So could you start us off with just an update from your vantage point as you're looking ahead, as you do, into the financial markets and the economy and the actions of the Fed? What things are on your radar that are either confirming or adjusting your expectations? Because you've talked with us in recent visits about a potential approximately mid-year increase in interest rates, which could impact the equity markets, which could cause a shift into metals or whatever. So tell us what you're seeing and give us a heads up of what you think is people need to be aware of that's likely to be in our near future.
So I believe what I said was we're going to see a rise in interest rates, but not by the Fed. The Fed's not going to raise rates to 2024. So we did see a rise. The 10-year note went from 0.3% to 1.77% year over year. So from summer 2020 to we're almost in the summer now, although it doesn't feel like it here in the Northeast. We'll be in the summer in a little over a month. So we did have a rise in interest rates, which is one of the reasons why I sold gold in September of 2020, because I said we're going to have a rise in nominal rates. It was going to be faster than a rise in inflation. But going to your point about the Fed, let me just stop and say that I do believe we're going to be re-entering the gold trade July, August, September timeframe. It's going to be a wonderful time to get back into the gold market, both physical and especially in the miners. And I'll get into that later if you want me to. But what I found interesting was that, you're listening to these the Fed heads talk. Now they're incessantly talking. Every single one of them talks. They have the most loquacious group of people I've ever seen in my life, and they keep talking and talking, and everything that comes out of their mouth is inane. And they just show their feckless nature. So I'm hearing lately that the Fed says, hey, we know inflation's out there, but it's going to be temporary. And don't worry if inflation gets out of control, because if inflation gets out of control, which, by the way, Dunnigan, we all know it already is. I mean, just try to buy a house, for goodness sake. Copper, lumber, energy now is raging out of control. But the most salient in asset prices. These people are just totally unaware or unwilling to admit that it's also most salient in asset prices, particularly the bond market and the equity market, and of course, ancillarily speaking, in the real estate market. I mean, Dunnigan, the Fed sold $40 billion of T-bills at an interest rate of 0% a few weeks ago. Zero, nothing, for free. I mean, if that's not, prima facie case of a massive bubble in bonds, then what else is? And everything else is geared towards that rate. So here's what makes me very angry is that the Fed comes out and says, don't worry if inflation gets out of control because we can always prick the bubble. We have the tools. What tools do they have? The tools they have is to what? Raise interest rates, stop QE, and then raise interest rates. So that's a pretty blunt instrument on both sides of the equation. But who could ever imagine that the Fed, after blowing up massive bubble in the stock market, we're now over 200% of GDP, the valuation of equities, over 200% of gross domestic product, never before even close to that level. And who is to believe that they couldn't do it in 2018? Remember in 2018, the Fed was saying, well, we're at 2.5%. This is towards the end of 2018, but we're going to go way above neutral. Because they have this swagger like, hey, we solved the problem of asset bubbles and intractable debt by building bigger asset bubbles and encouraging more debt. This is what they do, and taking interest rates lower and lower and lower every time. And they say, well, we have the tools to do it. Well, I say, go ahead. You know what? If you want to raise interest rates to 2.5% or higher, try it. Because the carnage that's going to occur when that happens will be replete and pernicious in nature. So that's where we are right now is further and further into the twilight zone, where we're engendering bigger and bigger bubbles, incurring more and more insolvent debt, and we have a Fed that's cheering it on because they want to make sure we have full employment and racial equality, which I'm all for racial equality, but it's outside of the purview of the Federal Reserve with their blunt instrument of taking interest rates to 0% and printing a bunch of money. Counterfeiting money does not engender racial equality. So they're going to keep doing this until we have full employment, egalitarian society, and then they're going to come and raise interest rates. And I'll wrap this long answer with this one statement. The Fed is never going to really get much off zero this time. I'll predict that. Please mark it, bookmark that prediction. They'll probably end QE, which is $120 billion a month, before they get to the end of QE, or maybe even if they get to maybe a 50 basis point hike in Fed funds rate, the whole wheels are going to fall off this economy. So they're never going to get, forget about above neutral, they'll never even get near neutral, which they say is 2.5%.
When you've talked to us in the past, you've talked, watch out for an interest rate spike, and you talked about an uncontrolled organic interest rate spike, not one that was led by the Fed. Is that still something that you're looking for, and are you still looking for it roughly mid-year?
So the way I think about this, no, I'm not looking for roughly mid-year. I'm looking for it to happen whenever the Fed says that, oh, okay, we raised interest rates by 50 basis points, we stopped QE. Whenever the next crisis happens, and they're going to be, like I said, barely off zero, if off zero at all. And when the Fed comes back into the game and says, oh, okay, guess what? Which was going to be an emergency measure in 2008. We had to go back in 2018 and 2019. We went, foot to the floor in 2020. And now in 2022, we have to do it again. And here's the question. It's not a prediction. I'm just raising it as a postulate. What if, and the odds are highly likely this could happen. What if they come in 2022 with another multiple $trillion stimulus package, right? Added to the $28 trillion national debt, all of which will be monetized once again by the Fed. And how dare they say it's this temporary and a once in a lifetime storm? Now, no, this is a pedestrian, banal function. This is your primary reaction function to a collapse in the stock market. If that's the case, what happens if the long end of the bond market says, because of your inflationary desires and your insolvent nature, Treasury, we're no longer going to buy the long end of the yield curve. We're going to sell it and short it, Wall Street. That's a very salient risk. Every other time in history when the Feds comes in to reliquify the financial system, they were successful because deflation was the problem. It was a temporary problem. Deflation showed it reared its ugly head, which I don't even think it's that ugly. I think it's very healthy, by the way. So deflation's a problem. They reliquify the bond market, and long-term interest rates don't go up; they go down. They stabilize and they start to trend down. The opposite could happen next time. That's a real risk.
That's something that our viewers are concerned about, is the impact on their lives and on their retirements and on their ability to purchase homes and everything else. That all of us that are wondering about what our financial future is, that's been one of the things that's been anxiety producing about this period of time that we've all called the COVID thing. But I'm not sure how much it has to do with an illness or how much it has to do with just this complete takeover of our financial lives and our futures, to where people feel that we can't even make empowered choices about what's going to happen in our future because we don't know what the rule book is going to be. The playing field is being redefined right around us. Do you have advice for people in this environment that we're living in to make it less fraught with, I guess, that feeling of helplessness that people are feeling, so they get back into the feeling of, okay, at least I don't know what's coming, but I have a plan for how I'm going to navigate it?
Well, the first thing you can do is turn on Dunning & Kaiser and turn off CNBS. That's the first thing you could do to make yourself feel a lot better, because the 60-40 portfolio, stocks and bonds, isn't going to help you. It's going to destroy you. I mean, as we're recording this interview today, the stock market's down 2%, and the bond prices are going down because we're in a massive bond bubble. So you're losing money in both ends. And even if the opposite was true, even if stock prices were heading down and bond prices were going up, your portfolio wouldn't be anywhere near offset by the demise in the stock market, because interest rates are 1.6% on the 10-year note. They just can't fall down to zero. If they go to zero, it's not going to offset you're going to have anywhere between a 30 and 80% catastrophe in the stock market whenever the Fed has the hubris to believe, the arrogance and hubris to believe that they solved all of our problems and they start tightening monetary policy. Stock market is going to go no bid for several weeks before the Fed says, oh my gosh, the credit market is frozen, we have to do something. The bonds that you have in your portfolio, even if they do go up in price, are not going to be anywhere near the capability of offsetting that loss in the stock market. From 1967 to 1981, the stock market went nowhere in nominal terms because of inflation. And because, when Paul Volcker came in and he crushed inflation, took rates to 20%. Forget about 20%, Dunnigan. We can't even get to 2. What would happen to these bubbles in the stock market, real estate market, if the Fed had to aggressively attack inflation? Well, I don't think they're going to aggressively attack inflation, but I think they're going to try to stop QE and not drain the balance sheet, but just approach neutrality. They're going to announce the path towards neutrality, which again, I said it's 2.5 on the Fed funds rate. That's going to be cataclysmic to the stock market. You'll see the credit markets freeze all over again. Junk bonds will collapse. Businesses will freeze up. And what can you do? Well, when you turn off CNBS and you turn on Dunning & Kaiser, you say, well, let me find, if you want to be an investor, you have to find an investment management company that actively manages the market and can do it in both ways, can go long and can go short, can raise cash, hide into the dollar, buy short-term treasuries, short the market when it's necessary. And it will be, my guess, sometime in 2020.
We've got a question here. You mentioned earlier about precious metals. We have a question here because we've talked with a number of analysts about a commodity supercycle, talking about a whole bunch of different commodities, and maybe you can mention some that you've been watching that are on a major increase. Philip Saunders says, commodity supercycle hasn't even begun on precious metals. Why are precious metals being overlooked?
Well, you do have a commodity supercycle. I mean, go try to buy some lumber, copper going through the roof. So we do have, a big supercycle in commodities. But why doesn't gold rally? Because gold isn't a commodity. It is not a commodity. Gold is a currency. It's an alternative currency to the US dollar. And what is gold like? It likes it when real interest rates are falling. So you cannot have inflation and growth accelerating rapidly like we had, like I predicted would happen in September of 2020 all the way to the summer of 2021. You have a reopening of the economy. Year-over-year growth rates and inflation are booming. They'll be above 3% on the CPI headline. It'll be announced later this week. Growth is 6-7% for the year because, hey, Dunnigan, no shock here. This is very easy to predict. If I told the consumer, this is what we told the consumer, don't have to pay your student loans. You don't have to pay your mortgage. We're going to give you an extra $300 or $600 to stay home and not produce anything in extended unemployment benefits. Oh, by the way, we'll also send trillions of dollars to everybody in your family. Everybody got, not everybody, I didn't get it, I'm sure you didn't either, but $1,400 checks, several tranches of that. Everybody in the family got 14, man, woman, and child, maybe even the dog got a check. I'm sure some fraud was there. Everybody got thousands and thousands of dollars to spend. Oh, and by the way, we're going to print so much money that the stock market goes up 20% in 2020. Or it didn't go up that much, but close to that. And this year, the market's up about 10%, the S&P 500. So, yeah, oh, that's great. I don't have to pay my mortgage. I don't have to pay my student loan. I can stay home and collect more money than I going to work. Stock market's going through the roof. And, oh, you're going to pay me to stay home, too, by sending me checks in the mail? And you wonder, well, of course growth is going to go bonkers. And inflation is going to go bonkers, of course. But it's all temporary and borrowed from the future. We still have all of this debt outstanding that has to be serviced. And the Fed's, walking around saying, we'll be able to service this debt without anybody at the Federal Reserve counterfeiting $1. And we can service this debt in the free market at a much higher interest rate. That's not going to work. It's not going to happen. So you need to be with an active manager that can go long and short the market. And in the bull market, I still think we're in a bull market. So we still have some time left here. What asset classes do you want to own? What style factors do you want to own? What sectors do you want to own? That's the key.
Now, you touched on gold there. You didn't mention silver. Silver has been getting a lot of press recently and a lot of attention at the retail buying level. In fact, Rick Rule hosted a seminar just last week called Robinhood, Reddit, and the Rise of the Retail Investor, talking about retail investment demand pushing into silver. Silver is an industrial commodity as well as a monetary metal, so it has not yet been appreciated. It's still only 60% of its all-time nominal high set back in 1980 and again in 2011. So as part of your thesis, can you address that as well as why you believe that silver has not participated in the commodity supercycle yet?
Well, silver should be doing fantastic because it is part of that industrial commodity, and also it's being used for silver salts are used even in solar energy. So I don't understand exactly why silver isn't doing quite as well, other than to rely on the fact that it is also a monetary metal, and anything monetary associated to it is not doing well when you have both growth and inflation, especially growth accelerating. That is why I said at the beginning of this interview that I think July, August, September, third quarter could be very bullish, maybe even bullish for silver because of its monetary element to it, but mostly in the vanguard bullish for gold. Because I do believe, at least on a second derivative basis, which is the secret of the universe, is calculus, you will see the second derivative of growth and inflation slow come the third quarter. And I can go into many, many reasons why, and probably more in this interview, but peak COVID optimism, peak vaccination, peak fiscal support, peak monetary growth, peak reopening of the economy. All those reasons will be a slowdown in the rate of growth and inflation, which should be enough to cap or even cause long-term rates to fall. And gold will absolutely love that, and especially into 2022 when we see just how unstable and unsustainable this recovery really is.
Okay, so if I'm understanding what you just said, it sounds very significant. Just like people have talked to us about peak oil or peak gold, it sounds like you're talking about peak recovery, that we'll have seen all the recovery we're going to see, and then the dark over the top of the hill. It's not the beautiful valley. It's, oh my gosh, we borrowed from the future and now we got nothing.
September 4th, come September 4th, the enhanced unemployment goes away. In the fall of 2021, this year, you will indeed have to start paying your mortgages. You are no longer going to receive any more multiple $1,000 checks in the mail. That's not going to happen any longer. You are no longer going to see $120 billion a month of QE. That's going to start to slow down at the end of this year. They'll probably, my guess is they're going to announce the taper in August or July or August. Jackson Hole is August, so that's probably the latest they'll announce it. And then it'll take 12 months from August to go from 120 billion to zero. So that's the time frame when I'm saying this is when you're going to get a problem in the credit markets. This is when the junk bond market will freeze. This is when the repo market will freeze. Please remember, in 2018, the latter portion of 2018, the Russell 2000 fell 30% and S&P fell 20% in a matter of a few weeks. That's when Mr. Powell came out and said, I didn't mean it. We're not really going to raise interest rates anymore. I promise to stop. But we are going to continue to drain the balance sheet. You had a nice little rebound in early 2019. But by the summer of 2019, interbank lending completely froze up. And that's when the market started crashing again. And that's when Mr. Powell said, okay, we're going back into QE and we're going to lower interest rates. So the question is, how far does the stock market have to go before Powell acquiesces to more QE? I think the number sticks out in my head is 30%, because that'll be more than enough to freeze all the credit markets. And the question again, do long-term interest rates respond favorably, or do they say, we are now sure that insolvency and inflation is intrinsic? It's not an idiosyncratic thing that happened once 12 years ago. It's now endemic in the U.S. economy, and we are eschewing U.S. treasuries. That's a question. That's a big question, because the answer to that question is the difference between a 30% pullback, which me and my clients have no desire to go through, or is it 80%, like the NASDAQ fell from 2000 to 2002? Is it going to be 80%? Well, if long-term interest rates don't behave right, it's going to be 80%, not 30%.
Several of our viewers that have investments in real estate, either their primary residence or actual housing that they own, are concerned about the real estate bubble. And you've talked about the equity bubble. And people are looking for what's going to be the first card that pulls out and the whole house of cards falls down, which can be tricky because it could maybe be any of them. But Fat Vegan says, when the banking system in Australia collapses due to an overpriced housing market, and we've certainly heard from several guests we've interviewed that the Australian housing market has just been a one-way ticket up for a long period of time. Do you believe that this will cause an entire epidemic crash throughout the world in the banking system?
Okay, so we have three bubbles. I call it the triumvirate of bubbles. So you've got number one in the vanguard is the bond bubble. Then you have the stock bubble, and then you have the real estate bubble. So I'll just give you a little anecdotal evidence of this. So I'm looking for a property in Naples, Florida. The home prices in Naples, Florida, in the last 6 months are up 50 to 80%, depending on the community. That has never happened before. And you look around about, looking for a home, and you realize the inventory is almost zero. There are entire communities in Naples, Florida, that have not one house for sale. And I said, this is unusual. It's never happened before. Not even in 2005, 6, were there no inventory. Now, the good thing about real estate is doesn't have the crazy exotic lending that occurred. The ninja loans, the no-doc loans. You give 5 houses to someone who doesn't have a job. That doesn't exist. But the home price to income ratio is greater than it's ever been before. So home prices are extremely high relative to income. It's all about, if you give private equity firms unlimited amount of money, and an unlimited capacity to borrow, what do? They borrow the money and just buy up whole tracts of land, commercial real estate, private real estate, everything, residential. They buy up everything. That's what you're competing with. Home flippers too. There's a whole army of home flippers in there, buying homes if they have an income, buying multiple properties and holding it for security, and hopefully they can flip it out. So so it is not in the vanguard. It's in the third position. Number 2 is equities. Number 1 is the bond market. But the catalyst for the 2008 credit crisis was the real estate market. It will not be this time. It is going to be a problem in the bond market, specifically the credit markets. When the credit markets begin to blow, one of the components of my model is the high yield spread, LIBOR, OIS, and junk bond spread to treasuries, 2 of them. You will see the MOVE index blow out. You'll see problems in the credit market. That'll freeze all lending in housing, okay? Because you're starting to already limit the amount of people that can buy homes, even with their incomes. The home prices are just out of reach, out of touch of reality. That's when the real estate market will collapse. But I think it'll be in concurrently or in reaction to the stock market plunging. So if you want to have an order to it, I think that was the question. The order is bond market, the credit markets freeze, the stock market tanks, and then the real estate market plunges. Now, I don't know if it's going to go down 33% like it did in 2008 to 2009, 2007 to 2009. I don't know if that's going to be the case, but you could definitely see double digit nationally speaking, at least double digit, 10 to 20% down very easily, depending upon how effective the Fed is in stemming the decline in the stock market.
This is related to a couple of topics that you touched on both here and in your previous discussion. Johnny Galt says, Michael, would we or would we not be in the same economic predicament we are today without the, quote, COVID pandemic? Based on your great book, The Coming Bond Market Collapse, I think you might agree that we have long been on a path with our current destiny in exponential debt, money printing, and so on. So does it seem that this pandemic was overhyped as a convenient scapegoat for our current and future economic troubles?
So thank you for reading the book. I appreciate the plug. So we were headed here anyway. I mean, I just talked about in 2019, the Fed was already lowering interest rates and already back into QE. So we were headed here anyway. COVID-19 expedited and exacerbated that path, but it's been this way since the year 2000, really. So the reaction function is a Fed, central bank, government can fix all problems. They have a tool to fix everything. They can ameliorate every problem. What we do is we take interest rates lower and we print up a bunch of money and we reliquify the debt market. Well, interest rates were 1%, only 1% for 1 year, 2003 to 2004. There was the housing crisis, right? Then we went to 0% after the credit crisis in 2008, right? This is the 1 year in response to the NASDAQ bubble. I don't know if I said that right. Then the housing bubble happened. We went to 0% for several years. And now we're at 0% and a 1.5 times record amount of QE. Because the last QE was 85 billion. Now we're at 120 billion. And we're going to be at zero. We've been at zero since 2020. We'll be at zero till at least 2024, right? And we'll be below 1 for about 5 years, at least 4 or 5 years. So, this cycle is very clear. Interest rates have to be lower and lower for longer and longer to engender bigger and bigger asset bubbles. Congratulations. This is what they're doing. I don't even think that's my opinion, Dunnigan. That's a fact. That's very well documented fact. Bubbles are getting bigger and bigger. The amount of debt outstanding is growing exponentially. We now have 50% corporate debt to GDP, lowest and tightest spreads to treasuries ever, lowest interest rates ever. Triple C debt rated triple C, which is the junkiest of junk, was below over 100 basis points below the normal rate for treasuries. Okay? This is what's happening in this country and all over the world, as a matter of fact, and all over the developed world. Junk bond debt trading below where not junk bond, the junkiest of junk, triple C, which is almost guaranteed to go back. You're almost guaranteed to not get your money back. 5.7%. The average on the 10-year is closer to 7, 6.5, 7. So that's what has been wrought upon us by government. Thank you very much.
We're running out of time for today, and I wanted to send you off with this one last one. You hinted at your exposure to runaway prices down in the Naples, Florida area, but we have a question from William Mueller. Hey, Michael, Andy from Miles Franklin just left Minnesota for Florida. Any plans to get the heck out of New Jersey?
Well, of course I do. Yeah, that's one of the reasons why I'm looking for property in Florida. You know, there's red states and there's blue states now. I'm a libertarian, so I'm not a big fan of Republicans. Republicans spent $4 trillion. The last year of Donald Trump's presidency was $4 trillion in debt. So now we have $6 trillion proposed from Joe Biden in the first 100 days. But New Jersey, well, you're going to have vaccine passports in New Jersey. Your kids won't be able to go to school. That's my prediction because New York just did it. New Jersey tends to follow whatever New York does. Murphy follows de Blasio. So you can't send your kids to school in New York City unless they get vaccinated. I don't want to get into the whole vaccine confrontation, but you're going to be limited as to where you can go and what you can do, and can your children attend school if you're not vaccinated. And I don't think that's the case under Ron DeSantis in Florida. So no state income tax and freedom sounds a lot. Oh, and not being freezing cold most of the year sounds a lot better than socialism and control here in the great Northeast. By the way, and crime out of control, especially in Manhattan.
Adding to your anecdote about real estate down there, my wife and I actually made an offer. People have been following our saga as we're looking for a lake frontage homestead. We made an offer on a place a weekend before last in Central Florida and got overbid, so we had to let that one go. So
just to add to your anecdote, my realtor told me if you're not going to pay cash at the offer price, don't call me. That's unusual. I mean, that's a little bit unusual. Cash at offer, because these things are all going on bidding wars, So that might be the definition of unsustainable. I know it's a seller's market, but when a seller can make up any number they want in the multiple millions and get it in a bidding war, that's the time when you're a buyer. You got to say, maybe I should wait. If I can, why don't I sell and rent for a little while? That's the smartest thing to do, because I think, a year from now, and especially 2 years from now, you're going to say, thank God I didn't buy that house.
Michael, if people want to follow your work, where should they get plugged in?
So the website is pentoport.com, and my email address is mpento@pentoport.com, and you can call the office here at 732-772-9500. If you have around $100,000 to invest, I'll personally handle your money in the IDEC strategy, which is the inflation, deflation, and economic cycle strategy. And if you don't have that, you can always, or even if you do, you can always go to the website. There's a free trial subscription to the podcast, Midweek Reality Check, a 5-week free trial. And if you do like it, it's below $50 a year. And it gives you, 36,000 foot insight as to what's going on. For instance, I recently told people that the stock market, this is all documented fact, that the stock market was overdue for a correction. I can't model it. I can't predict when it would start, but it's overdue for a correction. And we sold a lot of our high volatility exposure and went more into the utilities and the low volatility sectors. And that happened a few weeks ago. And it looks like, the last couple of days, it's coming to fruition. But if you think these last couple of days have been interesting, just wait until the Fed stops printing money and when the fiscal support gets pulled out from underneath the feet of consumers, and they have to indeed stop defraying their payments to student loans and to the mortgage bankers. That's when you're really going to see a problem. Like you said it best. You said it better. You said it better than I did. Peak everything. Peak optimism of COVID. Peak fiscal support. Peak monetary support. All that's happening right now.
Well, folks, if you don't want to miss any of Michael's interviews here or any of our guests, make sure you go to libertyandfinance.com. That's our homepage, libertyandfinance.com. Put your name and email address in the left-hand margin. Get on our free newsletter so you don't miss a single episode. We'll give you all of the details, all the links, all the descriptions of all of our interviews with all of our guests. Michael Pento, founder of Pento Portfolio Strategies, thanks for joining us again this time on Liberty and Finance.
Always a pleasure, Duncan.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded. For physical delivery, vault storage, or precious metals IRAs, excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. Call me directly at 419-819-9209 or my sons and fellow brokers at 310-562-6400 or 419-490-5295 or email us, kaiser@milesfranklin.com.